Okay, who's
All
going to
right.
introduce this guy?
All right.
First of all, cheers. Happy Friday.
Cheers.
Cheers.
Yeah.
Cheers, everybody.
I'm
Cheers.
having a Pinot Noir from California in honor of the fact that there will be no Pinot Noir made this year in California. So
Well,
there
very
you go.
noir. Very noir.
I'm having a lager from Mexico, I think.
Oh, nice.
I also love
Lager
that
from Belgium.
I just slacked to you and Mike that I'm not a beer guy.
Yeah.
I'm doing
Yeah, thank you, guys.
vermouth and tonic and a little bitters.
Ooh, I like
Very
that.
sophisticated.
Yeah,
Very
luckily, my neighbor makes his own vermouth and drops it off on my front door. So there is some benefits to living in this post-apocalyptic Smokeville Valley.
You just blew my mind. There's
Now that's a neighbor.
There are people making their own vermouth.
Yeah,
And
That
dropping
is-
them off to the neighbors, right?
You just live in the niche world in every respect, don't you, Jason?
I'd be lying if I didn't say that I just brought that up just for you, Rod. I knew you'd appreciate
Love
that
it.
one.
I freaking love it.
Well, those of you who are joining us, I mean, I think everyone will know Jason Buck, who's here today he's partner at Mutiny Fund. And this is a pretty interesting, high quality firm that really develops tail hedging solutions and strategies. So it is, which tail, how to hedge a tail, what the tail might be, tell me a story, all that good stuff. So it is a really exciting conversation with a lot of depth and context to the conversation. And I always love these types of conversations, especially when I have to tongue twist that shit out of my mouth. So
I swear this is the first time you've gone on camera in the very beginning of the conversation and marketed for the firm that we were talking to. Like I've never seen that before. That was amazing. So Jason, I don't know if you guys arranged in the before this thing,
Yeah.
but
Should we
Exactly, you
add
guys came on late.
we got a guy, he's got a beautiful open road hat on, and he's having a drink with vermouth and bitters. You can't get any cooler than that. And by the way, those are all signs that you should not take anything that you hear on this particular podcast as investment advice, because there is none of that happening here. Go get that from qualified professionals if you don't. This is a happy hour conversation that'll be wide ranging and fun. So here you go. There it is.
I want to piggyback on the disclaimer, though. I want to break this back. I've been a long-time listener, first-time caller on Resolve Riffs. And in the beginning, the idea of Riffs was that you guys would just turn on the camera and the mic so people could see all the shit you talk on a Friday to each other. And then since then, somehow this has morphed into a presentation where people come with decks and slides. And I want to let you know I am unprepared. This is a happy hour riff. And my only request is that nobody brings up the 3-body problem.
That's so
you just brought it up.
Okay.
So
Unless it's
what are your thoughts?
threesome.
No, we have to talk about it. What's hilarious
Unless
is
you're
that-
being literal.
What's hilarious is that we want to bring it up and we want our guests to talk about it all the time. And every single guest is like, I've read it. It's okay. And then moves on. Like we've never been able to get anybody to engage deeply on that. And Adam is like incredibly thirsty to get into
I am itching. Yeah.
Well, Ben wanted to go down the rabbit hole,
I
but
don't think so.
we were stuck a little bit in him wanting to burn the U.S. down, so we stayed clear.
I'm
There's
pretty
just too
sure
many
you
other
want to
directions,
be clear about
I
it.
think. Is the
That's
problem.
right.
So Jason is a mutineer, and so you guys are all about tail hedging. Are you getting a lot of interest these days? Like, are you seeing a spike in inquiries and engagement from people with this pullback?
Sure. So yeah, you guys know how this business goes. Is like, when did Noah build the ark? Before the flood, Gladys. Before the flood. But nobody seems to care before the flood. After the flood, they want their insurance protection. But luckily, we built Mutiny Fund so that way it was a permanent holding for long volatility and tail risk. We don't believe you should try to time your insurance. We wanted to create a product where, through the ensemble approach, you could actually hold it even as the market, tanks off and V-shaped recovers and all the craziness we've seen this year. So yeah, the interest has been just on fire since we launched in April.
That's great.
awesome.
And no major pickup in engagement over the last few weeks I guess it's like been a week and a half
Yeah.
of this little mini correction that seems to be, there's lots of drama online about, but so far it seems pretty benign.
Yeah, to me, it was a lot of noise. It's like everybody is everything quieted back down after March, and now people just want some action again. So then everybody, it's like, is this it again? Do we get to get involved again? And it was and lot of sound and fury in the end, signifying nothing so far. So,
Well, that's an interesting conversation to have. You had what, like a 4-day run in the Nasdaq where you went down 10%. So it was like the fastest 4-day in history or something like that. I don't know if this is true, by the way. I read it I heard it in a book I read.
Totally make it.
And immediately you start getting questions like, have you been in talks with guys at Mutiny? Like, you know what Chris Cole's doing? Like, how's his fund doing? And I'm like, it's hardly a tail, right? I remember the first week of March when it started to happen, it was like a 10%, 12% drawdown. Investors, like Chris Cole investors, were calling me furious that he hadn't performed. And I'm like, you have to readjust your definition of tail here, buddy. Like, you can't. And of course, like after that, he was incredibly happy. But yeah, this is a problem when we talk about tail, right? When we talk about that type of protection. If it were protecting right in the first 5%, then, you know, everybody would be doing it.
Tesla's down 8%. Where were you guys?
Exactly. Exactly. Yeah, we try to be explicit with our clients that anything less than 10% is just noise, and you can't cover that. If you wanted to cover right from 1% to 5% down, the bleed would just be so enormous that it would be pointless. So you have to pick kind of where, you know, you're gonna make your mark, and anything less than a 10% move is noise to us. But yes, we get those calls like, you know, it moved 2% today. Yeah, exactly.
And so you guys are
deductible, right?
Sorry, Adam, go ahead.
No, you go ahead.
No, I was just going to ask you. You guys are probably focused on the equity tail, which is what everyone seems to want to hedge. But do you guys ever consider other types of hedges across other major instruments, possibly bonds or other asset classes that you believe might offer an interesting way to approach this?
Well, you went out of your way not to mention gold, Richard. Good for you, man.
Well, I was going to mention that, but.
I think there's multiple ways to look at that. And actually, I'm going to end up throwing the question probably back to you guys, is that, yes, we try to primarily hedge against S&P beta. And for that, because for the most part, that's what most of the world has, like, especially as you know, North American investors and American, but like pretty much the rest of the world has a lot of S&P exposure. But then the question becomes, in a risk-off scenario, when you're moving from a low vol to a high vol environment and you have that phase shift, is there really basis risk? You know, this is the thing we think about often is like, if I'm trading other, you know, indices around the world, or, you know, interest rates or treasuries, et cetera, those correlations go to 1 when you have such a violent phase shift. So I'm not sure you have too much basis risk when we're moving from a low vol to a high vol environment. And then after you have that sell off in S&P, you know, the IV expands in S&P, so it becomes a lot more expensive for you to have those positions on. So maybe you could look for cheaper convexity in rates and treasuries and gold, et cetera. So that's one way of looking at it. But for the most part, we really try to focus on hedging that S&P beta exposure. But then the question becomes, after that sell-off too, are you now having enough duration of movements where commodity trend would be a better protection over that a longer, more drawn out, you know, lagging recession versus, you know, that sharp tail risk protection? Yeah,
I think this is a contentious point of conversation for all of us here, because I think I'm in line with the idea that the world only cares about that S&P risk, and that the basis risk is likely to be small. I mean, when everything's falling apart, and we saw it in March, and I've said this before, when you have those 3 days where it didn't matter what you held, whether it was gold or treasuries or equities, they all went down together for a very small period of time in that liquidity event. You could have had a hedge on anything and made some money, right? So I think the idea of tail for most people is that catastrophic point. That's, to me, that's what I like, what I really, really care about. But there's certainly other tails to hedge out there. I think the guys at Logic, you use Wayne's as part of your lineup, right? I remember back in the day when when I talked to Wayne, they did use some gold in there, no, as part of the tail.
Yeah, it's kind of like a dynamic proxy situation. So as they're long a straddle and they're gamma scalping it daily and adjusting their positions and their puts and calls, part of what they'll look at is, you know, if they can't load up on the inventory they want on puts or calls, they might look to proxies. So if they can't necessarily load up on S&P puts, you might use a little bit of proxy of gold or treasuries. Then the other way they look at it too is if, you know, you have that March event and vol's above 80, they might look to going maybe deeper in the money on those straddles, but also maybe look more to those proxies, because with vol whipping around at that size, it makes it pretty difficult.
Right.
But to your point,
You also
Rod, I
have
think that
short-term trend followers in your fund too, right? It's not just
Yeah. So the way we always like to look at it was, you can have these deterministic rolling puts where everybody knows the bleed of those, and where you're bleeding 3 to 5% a year, and you maybe use a negative 15 to 20% attachment point, and the bleed of those puts, but they're always on. Then you have like the more dynamic options managers, like the Universas, the Artemises, the Headwaters of the world, and we like to create a basket of those as well. But around the periphery, we add in back these VIX arbitrage managers, and then these short-term trend followers in the stock indices. And what they'll do is they can short those stock indices around the world. So what's great about that is, especially after March, as IV rises, they can go Delta 1 short those indices and just position that way. And it's, and as you guys know, it's incredibly difficult to be an intraday trend follower on markets.
Yeah.
Yeah, no, it's true. And it's, I mean, at least other than the recent March sell-off, the typical character of a drop is that you do get this sort of initial drop, and that tends to be abrupt and hard to predict and out of nowhere. And then you typically get some sort of follow through. And, I think if you go back, and there's 6 or 8 major bear markets, if you look at the US since 1900, the average recovery time is about 6 years from peak to trough to peak. And I mean, this has just been so anomalous, right? So really the only type of tail payoff that actually paid off this March was that true, just like always on out of the money put hedge. And even most of the trend followers, except for the ultra short term ones, were still caught offside for much of the move. And then those that weren't offside, or managed to catch some of the first move down, then were offside for the move up, or got whipsawed or whatever. It was just a very difficult test for trend following. So there's always this discussion about whether the character of the market has changed sufficiently that you need a wider variety of different types of hedge products in order to be able to capture all the different types of crises that might manifest.
Yeah, that's where I was trying to get at, because I think a lot of people are now thinking about the risks bonds pose, particularly sovereign bonds. And there's going to be a side of that argument that's going to say that central banks are going to continue doing what they're doing. There's yield curve control, what have you, and no one needs to really worry about that. But that becomes part of the risk. That adds to the risky environment that one day this might unravel and come undone. So I was wondering if you get some asks, or if there's any demand in that regard. I know that we have a couple of instruments. There's one VIX equivalent for treasuries.
The bond the move index.
The move, exactly. So wondering if that's a part of any conversations that you've been having.
Well, the move index is non-tradable, and Harley did a great job of inventing that. But the way we look at it is like going back to, whether you take S&P basis risk or not. We believe around the periphery, we're looking to add some of the more like European managers that might trade interest rate vol, treasury vol, and FX vol. And because those are so prohibitively low right now, that's because maybe ceteris paribus, it's telling you something that you're never going to make money off that. But as long as it's low or even positive carry, you don't really matter. But so we're looking to add those positions because then the volatility could manifest there. Like especially if we still somehow suppress volatility, domestically, does that then get squeezed out into the FX markets? And that's where we see it. We don't know a priori, but that's some of the positions we're looking to put on. But going back to what Adam was saying, I think that the way we kind of look at it is, we're not perma bears, we're not permanent long ball guys. We look at it as it's a piece to overall portfolio construction. And so, you can have instances like Adam pointed out, previous declines and recessions where, you have this phase shift from risk on, where all those implicit short vol trades, your stocks, bonds, PE, VC, they're all doing well. But then you have this violent phase shift to then before those commodity trend managers can take off. So we just want to really make money in that violent phase shift. So that way you can then rebalance and redistribute all those gains to the rest of your portfolio. And so, but then the thing that was always frustrating to me with building global tactical asset allocation portfolios, and Rodrigo and I talked about this many times privately, is we just hadn't seen in a long time where everything could have been in an uptrend and then you got that sharp reversal, because usually people are like, if they mentioned 87 or 2008, they were like stocks were in a downtrend, so they could almost market time their put protection. where, as you saw with risk parity or any other vol target, with everything you got, if everything's in an uptrend, you get your face ripped off in February, March. And then you might then, as you're adjusting, get whipsawed, like Adam's referring to, which is like a form of theta bleed, I guess. But like, we were just looking to try to protect or ballast those kind of portfolios, whether it's just, your stock and bond portfolio or just stock portfolio, or whether you really have a holistic portfolio. It's a nice piece to the puzzle to make some money when shit hits the fan and when everybody's running for the hills. And even more so than everything's on sale and you're the one sitting on cash. But now cash has a very different value. And that's hard to maybe sometimes get across. Cash in November of last year had a certain value, but cash at the end of March of this year had a very different value to it.
I just want to applaud you for using 2 Latin terms in one monologue there, along with some Greeks. So I think you're the first guest, certainly the first guest to wear a hat like that, to invoke 2 Latin expressions and some Greeks in the same monologue. So well done.
Adam's coming in hot already. I knew I was going to have to start drinking.
Just throwing some shade back at you, man. There's lots of shade thrown in through the chat channel usually.
I thought we were going to wait to talk about free will till at least like 45 minutes in. But here we go.
You keep throwing out things you don't want to talk about. It's like, don't remember this thing. And what's the first thing that comes into your mind?
Exactly.
You can't not remember something, right?
I'm just poking the bear.
Well, you're poking 4 bears here. We've been bears for like 10 years. So I don't, we're still waiting for our train to come in. But I'm sure it's coming.
Oh, before I forget, sorry, I don't mean to derail the conversation, but I just realized I'm super jealous. Rodrigo, are you up to 3 out of the 5 flags now on flag theory?
I totally missed that reference.
Oh man, I thought you'd be all over flag theory.
Not yet.
So flag theory is like where you were born in one place, so you have that passport. You move to another place, so you get a second passport. It's all about risk mitigation, right? Then you start your company in a third country. You hold your bank account in a fourth, and then you're basically like, there's a fifth, I can't remember, but then you're basically a PT, a permanent traveler, a permanent tourist, and that way you've diversified all. I thought you guys would be all over that shit with your.
Well, I think I just wrote a thesis on it and called it the Rodrigo effect. But there's something already out there called flag theory.
Oh yeah,
we're just not into labels. Really, some people are into labels.
You're not into labels.
So I do think that Richard was onto something. I know, right? Yeah.
I was very today. I got my Caymanian driver's license, and I was ecstatic. Like this is just
congrats.
the first step towards that third nation, and you are in land of many nations. I was, the people that I've met and befriended thus far are from nobody's from the same country.
Right.
You got a Spaniard, a Brazilian, a Peruvian, a guy from the UK, an Australian, a South African. It's fantastic. Who knew you could be more multicultural than downtown Toronto?
Yeah.
Just list off the Commonwealth nations. That's great. Yeah, exactly. Multicultural.
Yes. Yeah. Speaking of tail,
we've got the CARICOM nation here. This one.
So Jim Carroll, I guess, did you send him some of your neighbor's vermouth because he's on asking you the perfect setup questions for you to talk about mutiny? So, what is your view of single ticker offerings like Tail or Hedge or DWSH or Abrevix? And then number 2, is Mutiny available as in an SMA?
Man, Jim was tweeting before, and I asked him for softball questions, and he just hit me with the hammer right away. So this is one of the hardest questions we get always is, we love what you guys are doing. Do you have an ETF? Right? Yeah. So I'm sure you guys are used to these kind of questions.
Yep. Oh yeah.
Could
you construct a very complicated derivatives-based daily trading, trading multiple markets overnight in multiple jurisdictions?
Top-notch traders.
Yeah. Could you have that traded on the NYSE and make it so it's a penny wide all the time, if you don't mind?
Don't mind.
No fees to negative fees, right? You could. I don't want to pitch our book, but basically, my partner and I were just tired of having these conversations about with friends and family of I've read an Nassim Taleb book, a Chris Cole paper, whatever. How do I protect my portfolio? And I was going, do you have $20 to $50 million? No, well, you're fucked. So we were like, somebody needs to solve this problem.
True story.
We spent the better part of the last few years figuring out, what would all the workarounds be to bring a product like this to market. And so we think we finally, after a few years of working on it and getting all the approvals, we think we figured it out where we're able to take, retail investors accredited, why do we have to deal with this accreditation is beyond all of us. But with $100,000 minimums, and we allow them to access to these best in breed long volatility and tail risk managers. So we have done, I think, the best we possibly can to bring that ticket size down to as minimum as possible. Because some of our managers have $10 million ticket size minimum. So we think at 100K, we brought it as close as we can to retail. Sure, I wish I could stuff it inside an ETF. We actually talk with our mutual friends at Alpha Architects all the time. I annoy the shit out of them with questions every month, like, how could I stuff this into ETF? And they're like, that's too much leverage, that's too much derivatives. I'm like, but what if we change this? You know, like, it's just impossible with the regulations and the regulatory costs. When we talk about other products like Tail or the ABRIX and Aaron's product, and even Nancy Davis's Eyeball, we tend to recommend like all of them. But just like you guys, we firmly believe in an ensemble or mosaic approach to that basket. So you're not going to quite get the sophistication that we're able to offer via the managers we invest in with Mutiny Fund. But if I was building one with the retail ETFs, I would want to combine, a lot of those different products. And hopefully that gives me at least some pseudo tail risk protection. Like Mike, go ahead. Sorry.
Oh, just the challenge there is the capital efficiency of it all.
Yeah.
So keep going. Finish your thought, because maybe you'll wrap that into the comments.
The capital efficiency is another issue. So we even in-house offered our long volatility fund overlaid with 100% S&P exposure, because the capital efficiency we can use with rolling futures and have the combined cross margin. Now, if somebody wants full exposure, they can take it, and we think it's a great product and it's far superior to 60-40. But then if they don't want 100% exposure, they can toggle that down, and at least they get the capital efficiency then, rather than us doing 50-50. So we provide that capital efficiency. But with all of these products, and whether it's Tail or anything, and if you talk to Meb, as you guys know, is like how many he sees the people trading in and out of Tail all the time and trying to time Tail, trying to time their insurance. I think it's just crazy to me that like everybody is, everybody's portfolio of assets goes up when the market goes up and down when the market goes down. And then all I say is like, why not include something that goes up when the market goes down? And people look at me like they have two heads. It's like people have pulled their goalie in the first period of a hockey game. And I'm like, hey, that goalie might add value to your team a little bit, sometime along this game. But
so on that note, like, I love the idea of the combined portfolio, S&P plus the tail, capital efficiency, and so on.
Yeah.
When you have a product like the ones mentioned here, and I think like your product without it, when you don't have that capital efficiency, you need to allocate a lot more to it in order to get the protection for whatever equity allocation you have. I always struggle with this question, right? Because the way we used to do it is we're putting it in as efficient as possible. You're putting 2 or 3%, and that decays. And every 4 to 6 months, we have to call clients and be like, you got to re-up again. And that got old real quick. So your only other option, the most accessible option, is this one, where it's like the protection plus the cash, and then you have to overlay the S&P. How do you answer that question? Like how much tail in that type of product versus my S&P exposure?
As you know, the $64,000 question for all of us is position sizing, right? Portfolio construction and position sizing. That's what everything comes down to, is position size. And it's really hard to get that across. That's the most important piece. And Rodrigo, more than anybody that, you've felt the pain more than anybody of having that allocation, that 3% bleed. That's the most cash efficient. I firmly believe people should eat that bleed and balance it with your implicit short volatility or long GDP positions, and you're going to compound wealth better over multiple cycles. But you have to wait multiple cycles, right? And so all too well, better than we do, the behavioral problem with that. So we're just trying to solve that behavioral problem to try to make this hopefully flat or slightly positive carry over the business cycle or risk on cycle, which also means we can be down in quarters to years, but over the cycle we're trying our best. But so part of that is I look at it 3 ways to try to give people an idea, maybe 3 or 4 ways. One is, if you have less than 10% allocation to like a long vol tail risk product that like us, that's the bare minimum. As you know, that can barely ballast the drawdowns of 90% of the portfolio.
Yep.
If you take the perspective of risk parity, or I'll even go back to permanent portfolio, is if you view Harry Brown's permanent portfolio of 25% in stocks, bonds, gold, and cash to handle any macro environment, I would take the 25% in cash and allocate that to long volatility tail risk. And this actually, because it's a much more convex cash position to make up for the left tails that you would experience in the stocks and bonds, especially if their correlations come back to positive. And it goes back to something Adam said. I just wonder how much the markets are changing, and with the notional leverage across not only trading but in the economy, that you almost need derivative exposure, that structural negative correlation, to make up for the rapidity or the sharpness of those drawdowns. So that's one way we think about it. The other one is, if you look at classic 60-40, I don't know why we got anchored to 60-40. To me, it would be 40-60, that you would be 40% short volatility, 60% long volatility, do the extreme left tails of short volatility. And so people like that blows their minds because they're so anchored to 60-40 the other way, that if you just look at it mathematically, it compounds wealth better over time, but you're going to probably drag behind your neighbor for years at a time. But because of that huge left tail, stocks and bonds are implicit short volatility, that you're really going to ballast it out that way. Then another way that's maybe a little crazier, but I'm a guy in a hat drinking vermouth, is that we look at it as an entrepreneurial put option. So myself as an entrepreneur, I look at my holistic risk, right? I have my business risk, I have my house, I have my car, I have my girlfriend's profession. I have all of those risks to worry about as holistic risks. So any savings I have left over after consumption, I put it all in long volatility tail risk, because I really want that cash when shit hits the fan. And then I can go out and buy assets for pennies on the dollar because of the pain that we've all lived through and those experiences of what that's like to not have cash on the books when those things happen.
I also love that. I actually heard Meb say that he used tail protection for his own business, like the business bought it. And because he's exposed to a lot of beta just from his many products. Meb had that big cash position that he could reinvest into the company.
Meb went out of his way to draw that to the attention of advisors everywhere. Like you've got beta on beta on beta in your business. So where should your investments be? Well, one would have to consider having a pretty significant, tail type investment in your portfolio, so that when shit hits the fan, you've got actually an asset that has had a positive convexity. If you think about that, if you sort of take that through to other business models and other entrepreneurs, because we know where most entrepreneurs put most of their business risk is in their small business. Now go talk to any restaurateur, go talk to any hotelier, go talk to any and basically any small business. And if they would have had a significant, now obviously they've been saved. If they had the S&P, they're fine. But if we walked that out during March, they would have probably felt a little better with the tail hedge in their portfolios, or actually being their portfolio recognizing the risk they have in their own business, sort of crossing the chasm between the public markets that they're invested in and the private enterprises that they might own. I wonder if there's a fourth function. I think you talked about it a little bit with the 60-40, but it is to basically eliminate the bond. Everyone's worried about bonds. Sovereign bonds may not have any return. What if we get into an inflationary environment? So let's just eliminate the whole bond portfolio and replace it with the convexity that comes with the big strategies, and not have to worry about that type of idea. Oh, I'm just throwing it out there, guys. Don't shake your heads yet.
Oh well, I
know it's a crazy idea. But all I hear is, oh, my bonds, what are they telling me? Well, what are they telling you at 68 basis points for 10 years or whatever it is? They're telling, they're alluding to a lot of different opportunities for shit to go wrong.
Yeah. What though? I anchored to your permanent portfolio approach, and I do want to address what you said, Mike. But can I share my screen on you?
Oh no!
Here comes the chart.
While he's sharing,
he almost dared me.
While he's sharing the screen, this is where my mind went too. Is that if I was going to actually replace something in the permanent portfolio at the current rate level, I might actually replace the bonds and keep the cash, because the cash will actually rise. The potential return on the cash rises if returns rise in cash, and I'm getting convexity in a bond-like way in the permanent portfolio. I'm sure you don't care where I replace the 25% from, as long as it goes to Mutiny.
We'll take all of it. But look at
that freaky graphic right there.
I would disagree, and I might be front running Rodrigo on this. Is that if you think about the permanent portfolio, and your bonds are more for a deflationary protection. So if you're not going to use government bonds, maybe you look at, alternative fixed income with real assets. And that's why I view it more the cash position. But going back to what you're saying, Mike, what I do agree with is if your primary holding is stocks and you're using bonds as a portfolio weight to reduce the volatility in stocks, then that would be a replacement for the bonds. And that's why we think we're much better than a 60-40. Right. So it's as it's multi-layered. And I think Rodrigo's done a great job of even talking about, from here to zero, there's still, great returns on long bonds. And then if real rates are higher than interest rates, there's another kicker there. The problem is, I guess, if we go negative, then it's, as Mike Green would say, then you essentially have a bleeding put option without the convexity. But
yeah, it becomes return-free risk, right? It remains as, but I think people have been trying to short German bonds for the last 5 years since they became zero bound, and I think for the JGBs it's been 30 maybe.
Yep.
So I guess that whole trade and that whole idea that bonds are just gone. And granted, I go to that initial knee-jerk reaction, sort of, I don't want to own bonds in the portfolio from a gut reaction early on. But when you think it through and you go back in history and you look at these other sovereigns, it doesn't seem like that reaction has been there all the time. Which isn't to say that the risk isn't there and that this time couldn't be different, right? That whole paradigm shift idea, it could be there, but
I have one further point to add on that, Richard, because I think there is, which I just realized as we're talking about this. One, we're talking about the first initial potential reaction for longer sovereign bonds to be able to create some sort of ballast in the portfolio. That's one thing, and that's over the next crisis. Over the next 30 years, it's very difficult to argue that bonds are going to provide the same amount of ballast and drift that they provided over the last 30 years.
But that could end in,
So two slightly
years, right?
What's that?
All of that could be, when we talk about 20 years, well, what if bonds blow up in a 2-year period and all of a sudden they become super valuable, right? They have this massive.
There's the path.
But if you were invested,
there's path.
Hold up. This is what I kind of want to show. Like the idea of the permanent portfolio was that some gold, some treasuries, some equities, and then some tail protection, right? I think when you have that diversification, what people fail to understand is that you have the diversification because you can't foresee the future. You don't know whether treasuries over the next 5 years is going to be the best performing asset as it goes from 0.7 to -3. Mm-hmm. So it could be the best 5 years for bonds we've ever experienced, or it could be the worst thing. And it's probably going to be, if it's going to happen, it's going to be highly correlated to equities. It's probably going to be because of inflationary pressures. And if that is the case, then we're going to see some ridiculous outsized returns from gold and commodities and that's that inflationary push upward, right? So if you have that in your portfolio and you can't foresee the future, you admit that you can't foresee the future, then you may not have a bad experience, even with the shitty expected returns that we might see from treasuries and from equities in a high inflation scenario, as long as you have that gold in there.
Sure, but at the end of the day, gold notwithstanding, which is correct, right? So the bonds will not provide the returns that they have provided over the last 30 years is the sort of the theme. And that's because you had a discount rate, and everything in your portfolio that is a cash flowing asset is priced off of that discount rate that's gone from 18% to 0.
But I think
what was a real, when I hear those numbers, I often I'm not sure. I think there is a VIG there, but is there, what were the real returns when nominal rates were at 18%? Actually, I think Corey did something on this. Maybe you could pipe in. But is there a lot of value in true?
Yeah, they probably average 3% real returns or something like that, or negative. Yeah. So
what are real returns today?
Yeah, my favorite part about all this is just the irony of watching you guys debate this, because you guys have done better than almost anybody about educating people about global tactical asset allocations. Is there's always going to be a part of your portfolio that's absolutely repugnant and odious and you don't want to own.
Correct.
Yeah, so you're arguing about how bad bonds stink.
We're allowing the narrative that comes from the gut feelings come undone, and then Adam's just shaking his head going, please God, let it stop.
No, we always bring this up, right? The idea of do people care about real or nominal returns, right? And I think we've done we published out our research and we had a lot of conversations. I think we try to skew to real returns, but I'm coming to terms with the fact that nobody gives a shit about real returns. And in fact, people only actually care about nominal returns. And maybe that'll change if we go into some sort of Weimar inflationary regime. But, barring high teen inflation again, I think that nominal returns are going to be what people anchor to for the most part. And so it's
I disagree, Adam. 4 or 5% inflation, I think, would be enough. People have anchored at sub 2% for a long time. If it goes to 4, that's already 2x. And inflation is creeping up in cost of living in many other areas that aren't really captured by CPI because of substitution.
It's fine, that's true. But the reality is, if you deliver the best, you want to hedge inflation, deliver the best nominal returns you can. Right? There's no sort of inflation hedge that's going to guarantee you can go and get tips inflation or buy tips, and you're going to be hedged against the CPI, which the government is able to go in and change the definition of, and it may not be representative of your consumption basket. There's no good inflation hedge. There's not even a good consensus on the definition of inflation, right? So what inflation are we hedging? I was going to go back and ask Jason, like in the era of the omnipresent Fed put, I would actually push back and say, why does anybody even need tail protection insurance? What tail are we protecting? The Fed is going to protect nominal returns.
Sure.
But they cannot protect real returns. So shouldn't we all just be buying puts on the dollar?
Yeah, I look at it two ways. One is, you're right, there's a Fed put so far, and that I would ask, how did that Fed put work out in March when we were down 35%? It takes a while for the gears of the Fed put to get rolling.
That's fine, but nobody benchmarks liabilities to 3 weeks of returns or 9 days of returns, right? Like the reality is the Fed stepped in with everything in their arsenal, and stocks went to new highs more rapidly by a factor of 5 than they have ever gone up before.
Yep.
And they have continued to demonstrate that they will not allow this market to break in nominal terms. They will not allow it. And when it breaks again, they will be in buying stock indices. And when it breaks again, they'll be in buying individual stocks. They have demonstrated time and again that they will not allow this market to break. So they cannot control both.
The system is built on it, right?
And the dollar. So they've already said they're all in on nominal prices, which means that they are willing to sacrifice the dollar. So where's the real tail?
Sure. So I'll answer that a couple ways. Well, inflation is one tail. That's another tail that we think about often, but that might, that's not what we cover with our portfolio currently. But the other way I look at it, you guys actually had this argument before, is I wonder how much, Adam, you started out as discretionary, then went to quant, but as, Tropic Thunders taught us, you never go full quant. So, maybe we need to bring your art and philosophy back a little, as Rodrigo and Richard are far too aware of, is there's massive left tails that none of us could think about. And so to me, the Fed put is a Malthusian bargain. It only has to be wrong once, and I'll be waiting there, happily just waiting to bring it all in, have that inventory on my books.
Absolutely. Great answer. And I would also say that there's an answer for your product. Remember, the way you've thought about it, you came from how do you help your friends and family? That's retail. Right. And the truth is that we're not talking about matching liabilities. We're not talking about the fact that it's going to go down and then go back up and you can't move fast enough. The vast majority of retail investors, as we learned from Dan Egan and even Portnoy in his interview recently, is behaviorally flawed. So what you're hedging against is making bad mistakes. At the worst of it, even if you think that the Fed's going to be there for you 3 or 4 months down the line, right?
That's fine, but the point is the volatility risk premium. That's what you're describing, the volatility risk premium. I'm uncomfortable with short-term losses. I wish I could make Mike's whiny voice. I don't like short-term losses. That's terrible. But I don't. This is uncomfortable. I'm afraid. But the reality is that from a financial standpoint, the big boys don't really give a shit about a stock market that drops for 3 weeks and then rebounds at, the big boys, the 40%.
Were like how many, there was coverage of indices that chose not to rebalance. Those are the big boys making big boy mistakes, right?
Sure. So they didn't rebalance the S&P or, a few of the different indices. I hear you. That's fine.
And hindsight on one data point. Example. You're looking at hindsight on one data point just because the market was recovered this time. We can't go off of one data point. But to piggyback on several things Adam's saying that I think are interesting, that maybe takes us off down a different road, is what's the right thing to do? And I think you guys are so good about this a lot of times. But part of it is like, do we do the right thing to do, or do we do what the clients want? So going back to your nominal versus real, right? So if the permanent portfolio, let's say, chugs along at 2 to 3% annualized real returns above inflation, like you said, all we want is our savings to keep pace or outpace inflation and be there when we need them. So that's one way to look at it. I just did an interview with Steve Diggle that I thought was fascinating, where we talk about what is money or wealth. Steve had a huge windfall in 2008, And then now, what does he do? Does he think about money differently or wealth differently? So now he's going out to buy a basket or ensemble approach to real assets with farmland all over the world, to German rental properties, to then barbell that with a little bit of VC exposure too, to kind of create a flywheel. But my question for him was, great. Everybody say, that's great for you, Steve. You made hundreds of millions of dollars. You're in your 50s, but I'm 25. What do I do? My argument is, and I'm curious your guys' take. If you're 25 and you're making, let's say you're doing great, you're making 100 grand a year, you should treat your savings the same way Steve Diggles treats his savings. You want to increase your amount of savings through your job or through your entrepreneurial activities, but you want to have a well-balanced portfolio that keeps pace with or outpaces inflation and will be there when you need it, whether that's 1 year from now or 50 years from now. And it's incumbent on us to not tell the clients what they want, but what they actually need. And, you know, you guys have gone down this road better than most. And it reminds me of your first podcast with Ben Hunt, where he said, if you do that the right way, you'll be a much smaller business. But it might be but as I said, it's the pride of the craftsman. At least you have that internal pride. Like, you could have a much bigger business if you sold bullshit, but that's not what you guys do.
So there's like, so the question in there, I think, was, what does a 25-year-old do? So you're earning whatever, 100 grand a year. You're
real matters.
Retirement to be funded from your savings. And so how would you invest?
Yeah,
I mean, maybe I'll go last.
You need to focus on real, is my point. You were saying, fuck it, let's just go nominal. My point is, you should always be focused on real and building a well-balanced portfolio of an ensemble approach to short ball and an ensemble approach to long ball, rebalanced properly, that then you worry about your real returns after inflation year after year after year after year. And as we all know, by reducing volatility, you reduce volatility drag and you compound wealth better. And it's there when you fucking need it, whether it's 1 year, 10 years, or 50 years. Not like, oh, if I invest in stocks now and the big drawdown happens when I'm 28, I've still got 50 years to make up for it. Come on, it's fucking nonsense. That's, you know, I should get fined for saying ergodicity, but it's an ergodicity problem.
Yeah, I mean, it depends on how far down the rabbit hole you want to go, right? I mean, there is this sort of what risk are we hedging? If it's the cataclysmic risk, then we're all sort of in this together, and you don't even want gold, you want guns and beans and shit, right? So let's take a step back from that. And right. You're 25, you've got a 30 or 40 year investment horizon. You know, I'd say candidly, if you're 25, some kind of global equity proxy is probably fine, right? The reality is the conversations that we have are with people who are in their 40s and 50s, where they've got maybe 10 or 15 years before they retire. And the correlation between the sustainable income they can draw from their portfolio and the returns, the real returns they get on that portfolio over the next 10 or 5 or 15 years is extremely high, right? It's not the same kind of equation for a 25-year-old as it is for a 45, 50, 55-year-old. And that's a much more interesting and
I'm actually arguing it's the same
problem, right?
I'm actually arguing it's the same. You still have a...
I know you are. I'm not convinced it is.
Yeah, because you're guessing that they have 10, 15 years, your 45 to 50-year-old client, 55-year-old client. You're assuming the 25-year-old client has 40 years. Neither of those are true. It's the time versus the ensemble average, right? None of us know when we're going to die or when we're going to need money or when we're going to fall sick or when the next COVID is. None of us know.
And that's where he dropped ergodicity. That's where he dropped her. That's where it fit.
Yeah. No, but the whole point of ergodicity is that there is a day or week or month along the way that derails the entire path.
Changes it all. Yeah.
So that's fine. And I agree. But the point is that matters a lot more if you don't have time to recover from that major event. Right.
It's double serendipity though. My point is the well-diversified portfolio with also tail risk and options, and then whether it's modern risk parity or not, combining that overarching portfolio, it actually compounds better than any other. There's no reason to say that 25-year-old should be all global equities, because it will actually compound better by reducing the volatility for the 25-year-old as well as the 55-year-old.
Totally. Arithmetic versus geometric returns.
I agree. Permanent portfolio and risk parity, what have you. I guess what I'm saying is, if you've got a 30 or 40 year horizon, it matters a lot less. I would argue that the permanent portfolio or risk parity is still the optimal solution, levered to the right risk level. But if you choose levered risk parity or a global equity portfolio,
those are two very different. Those are two very different approaches in terms of their ability to navigate the uncertainty of potentially walking into an inflationary regime or potentially looking into a dollar slide that provide.
I think we're talking about, if we can summarize it to the high risk area when you're pre and post retirement, right? That first year of your retirement, if you have a poor investment outcome, it represents something like 20% of the overall success of the entire portfolio.
Yeah.
And so those first, it goes down, it's like 20, 18, 15, whatever, it drops, but those first 5 years. And so there's some stickiness to the lifestyle, right? I own X dollars and I am about to retire. And thus those X dollars are to pay for my golf course. I do not like golfing on public courses. Once you golf at your private course, I don't want to drive a Hyundai or ride a bike when I drive my Mercedes. So I have a level in my mind that I've accepted as my reality, and I have an amount of money, and that is staring me right in the face, versus a 25-year-old who doesn't really know any of that. And if they encounter an unlucky stream of events, they're going to come to a place that they're used to living in, whatever that particular lifestyle is. I think there's a lifestyle shock that occurs.
And their entire peer group encounters.
Correct. Well, that's the whole life. Yes.
And makes the same adjustments at the same time. And we all know that happiness is a relative context, not an absolute context, right? So if you and all your friends suffer in the same way at the same time for the same reasons, it doesn't even, it hurts much less, right? So listen, it's sort of a hypothetical argument anyways. Like, I think we all agree diversification.
They're the best kind.
No diversification.
I thought we did, Adam. Before you went down this rabbit hole, I really thought we did.
You know what my main thrust is? The investment problem for a 25-year-old is not very interesting. That's my main thrust.
Yeah.
There's so much
Bitcoin, baby. Bitcoin, Tesla.
Yeah.
Right.
Let me ask you a different way. Like, actually, I was just doing my favorite thing I like to do when I watch these resolve riffs is I look at Rodrigo and I imagine what he's thinking. But I don't know if you guys ever saw that 80s movie. It's like, what are you thinking of? It's like swimming pools.
Can I be honest?
It was like Airheads, I think. Was that movie called like Airheads?
I went down the permanent portfolio rabbit hole in our
like,
internal plotting app, and I like cut out like 5 different charts I want to show that I'll never be allowed to show. Clearly. Sorry, what were you guys saying the last 15 minutes?
Yeah. So Adam, I have maybe a different question. I'm curious how you guys think about, because I can't stop thinking about this. Is like, we all have, due to these conventions of the retirement account in North America, is this idea of absorbing barrier that then you're worried about with your 45 or 55-year-old clients. I'm very curious about how you construct portfolios that then maybe is not in a tax advantaged account, but maybe takes advantage of borrowing against your overarching portfolio. So you don't have defined, reductions once you hit 70 and a half years old. And so then you can transform a portfolio to make sure it is more short-term and long-term and well-diversified, while not having to worry about having to take those drawdowns when it hurts you the most.
Yeah. So you're talking about sort of asset location. Is that?
No, it's more like like you'll see like a tech giant use equity lines of credit. Like, Elon Musk will borrow a loan against his stock, so then he doesn't have a tax consequence. So if you had like an ETF, the whole world ETFs, that was a well-diversified portfolio that you could buy and hold forever. And then when you reach retirement age, if you just start drawing like 2% loan against that with Interactive Brokers is like at 1%, maybe 1.2%, it's a way for your overarching portfolio to still continue to compound when you're actually withdrawing less, and you're not worried about that absorbing barrier of when you retire and having to take forced liquidation of those assets.
Right. So don't bother to fund the retirement accounts because of the constraints that you need to liquidate at a certain rate. Is that kind of where you're going?
Yeah, I'm asking like from your guys' putting all of your 4 entrepreneurial hats together, is like, well, how do you think about that? Like, because it just bothers the shit out of me that you have this absorbing barrier that the government is telling you when you have to take a withdrawal. And we all know if that happens during a massive drawdown, especially if stock bonds are correlated, everybody's fucked. So it's like, is there a way around that? And that's what I'm asking. Like, I'm trying to think creatively, and I'm sure you guys have thought about it. Is there a way around some of these issues that we're constantly dealing with?
Well, I mean, we have a lot of clients that already do that, right? We've got a lot of clients that put on deposit large stock positions, and they use that to collateralize futures accounts, right? So that is that's a large business for us, and I think we obviously endorse that as an excellent strategy. And there's ways that you can hedge the stock position or not, or there's lots of different ways to roll that. And I like the way you're thinking. Like, certainly the forced liquidation of retirement accounts, and by the way, we have the exact same problem in Canada, but the forced liquidation of retirement accounts adds a layer of it amplifies the ergodicity problem, right?
Right.
Which I think the strategy that you're endorsing and that we employ for a lot of clients goes some way to addressing. So that's
and I wonder if maybe Corey I wonder if anybody's ever addressed it. Like, what I've always wondered is the tax advantages that you get until that retirement age. I wonder if they could be completely offset by those forced liquidations into a sell-off market. Like, is it really, are you actually adding up ahead by trying to take a tax advantage account instead of having a taxed account? And maybe Corey or somebody else has done some work on this, but I doubt it.
Well, it functions a little bit. It's slightly different in Canada, but it is, the money you get back is like an interest-free non-recourse loan, if you will, to the portfolio, which is awfully hard to beat. And that compounds for a very long period of time. And then, part of the solution to the problem is to construct the thoughtful portfolio with products that will prevent the issue wielding its head. So prevent the 40% drawdown in your portfolio construction within your portfolio. Then you're forced to take some out. You're right. You have this smaller amount. And then if there is a rebound, you're taxed on that rebound, even if you did shrink your spending in order to offset that. So there's definitely a drag there. But
again, there's a few things here. Number one, the first line of defense is diversification, both from asset allocation and strategy diversification, the like, so that when you are, there is no forced, well, I guess there's a force moving from a taxable to non-taxable. You don't have to pay taxes. You don't have to sell your positions. You can transfer the actual units from your non-taxable to your taxable. And as long as that's diversified and the world is blowing up and you're not, because you have this beautiful permanent portfolio with tail protection in it, then really the issue becomes, I think the bigger question is, depending on the whole idea behind deferring, putting stuff in your IRAs, or in Canada, it's RRSPs, is that you are going to be withdrawing at a time where your income's lower. And for a lot of people, that's not the case. And so for those people that are still in the highest tax bracket, right at the time that you're going to be taking it out, is it that much more beneficial than being able to do more things than you're allowed to do in your RSP and IRA and the like? That's a whole different conversation. But
it just depends so much on what is the future path of taxation. What is the distribution that you're expecting for returns? How much negative skew are we expecting in the distribution? What's the long-term mean? Like, there's so many different pieces to that. I think it's, some of it's just, I'm going to put a little bit over here, and I'm going to put a little bit over here, and I'm going to try a few things. And like Rodrigo said, and I think what we've all been saying is just diversify all the bets in the different dimensions you can. And I do want to point to the fact that a few people, Brian and Jim in the comments did mention that a Roth IRA or an IRA rollover, there are methods in the US that you can employ to address some of these sort of forced liquidation issues or tax related issues that I don't think anybody on this call is a particular expert in, but they're certainly worth contemplating for sure.
Right. I think it's just what Mike Green's thesis is. I don't know why he has to put such a long deck together to say the most obvious thing that we've seen from all of our clients is that if they're only allowed to invest in stocks or bonds or target date funds, that is going to have perverse consequences over time.
Yep.
Like, it's really that simple.
He gets paid by the slide, obviously.
Yeah.
I mean, this is a classic. You can't go to a very sophisticated conference and just say that and then drop the mic.
Yeah. Statements of the obvious never work out, I guess.
Jason, I have a question for you, because you live in an area where there's a lot of VC, private equity, big private pools with long lockups and the like. I used to think that would be ripe for the picking for a tail protection strap. But you go to these guys and you say, look, you have the most tail to protect, and it's going to happen all at once. And when it does happen, it's going to be catastrophic for your fund. But none of them would ever care or listen to me, because I'm curious to hear why you what your experience is with talking to VC people, and then I'll share some of the responses that I got.
It's probably the
You
same
mean
as mine.
all VCs aren't pessimists?
Yeah, they're long optionality. What tail do they need to protect? It's only upside for them.
And also
Well,
basis risk, right? The businesses that they're investing in don't necessarily have a high beta to the S&P. They might have these one-offs that are going bust that aren't necessarily going to be protected by liquid tail protection.
Yeah, well, I mean, we're talking about like systemic risk to the global.
Systemic risk for sure, yes.
By the way, which is what I'm the only thing I'm ever talking about when I talk about tail. And the response from these guys was even more like, if I do that, I've thought about it, but if I do that, like I'm competing against other VC funds. And if I underperform by this much because of your goddamn drag, I'm done. Like I cannot afford to have any drag.
It's the same argument to every other manager.
Correct.
Right. Well, do you think they would do it in their PA then? Or what's even worse than that argument I've heard from people that even like are, let's say they're long a tech company and they're long the stock and they're long the stock options. And I always talk about maybe you should hedge with some puts. And then they think that's somehow that's magical thinking that they're going to bring down their company if they buy puts on their company.
Right. It's also not conviction. There's no conviction there, and that's a problem, right?
How can you, after they're the turkey that has been treated insanely well by the farmer for so long, why on earth would why would that thought even cross their mind?
I agree. That was exactly what
right? Because I've always been saying, just wait. When this thing comes down on your head, it's going to be so bad for you. Though all your PE, all these pension plans and invest in PE. Then I sit down with the pension plans, and they're like, "I'm like, how you doing? How's your PE?" He's like, "Oh, thank God for that private equity." Because we're not going to see those losses for another 18 months.
Well, that's the other thing, right? Private equity.
There's actual marks, like negative marks.
Helped you, like
they're able to mark them back up again. Like it's
exactly. If you were able to mark the market right now, what would it be? Like, it'd be horrendous. It'd be the worst thing on the market. But that's the beautiful thing about accounting, like the accounting based at NAV, that we don't have to do that, and it's a bit of a blessing, and it keeps
we should all be allowed to mark the make believe, honestly.
Or honest and confident and comfortable. They don't have to see the market. It's the best. I mean, it'll be crazy. There's nothing that they could do wrong.
It's a behavioral advancement in financial technology. They can mark up their long range expected returns as a pension fund by investing in private assets that they can't get out of, and if at any time that they would need a bid, there will be no bid. But they are allowed to mark up their long-term rate assumptions, appease the board, appease the actuaries and the pension plan. I mean, it is, it's a great scheme as long as it continues to operate. I mean, you got to say
if the Fed put continues. I mean, that is the area that's going to benefit the most.
Well, totally. I mean, it's the area that has benefited the most definitionally by the change in the discount rate and illiquidity and all of these things. They have funded this thing to the nth degree. What do you think infrastructure is? I mean, it is the most long dated asset you can have. If you think your bonds are a problem, my God, how's it going to how's your freaking infrastructure project
in this
going to work?
nuclear plant or this water plant? Exactly.
Wait, Mike, are you going to go down the new Green Deal? I just want to prepare for that if you are.
No.
But I wanted to kind of maybe shift gears a little bit to ask Jason, because you've mentioned kind of tangentially about some of the holdings that you have in Mutiny, and you mentioned Logica, but you also said that you're not just hedging for tail, you're actually trying to construct sort of a diversified holding there. So maybe you want to mention some of the strategies. You don't have to mention them by name, but maybe the framework that you use. And then perhaps in the broader scope, what kind of portfolio you'd be looking to create in that diversified approach that you think is an interesting way to fit the Mutiny structure in an overall portfolio.
Sure, that's a great question. So let me start with, by the way, Adam's, saying that, happiness is relative, but I'm not so certain based on this crowd. I think it's the inverse, right? There's a bunch of Schadenfreude in this crowd. Everybody's waiting for the VCs to die off in the PE, and I don't think it's inversely correlated.
Not fair, man. It's not fair.
Yeah, exactly. So the way I like to think about it is, we all come from the same background, right? Of this Harry Brown's permanent portfolio, then risk parity and these intellectual developments. And then you get to Chris Cole's Dragon portfolio. And to me, they're all kind of, we can argue about the attenuation of percentages here or there, but they're all relatively the same thing. So we think about Mutiny Fund, this ensemble approach to long volatility and tail risk, just being a piece of that Dragon portfolio. So like the Dragon portfolio is 1/5 each: stocks, bonds, gold, long volatility tail risk, and commodity trend. So we built this long volatility tail risk piece because my partner Taylor and I just must be insane and gluttons for punishment, because it was the hardest piece to build by far. It's the hardest piece to sell, but we wanted to build that piece first. It's because what we needed for our friends and family. So this is very scratch your own itch, soul in the game project for us. So we built that first, but then we are looking to add an ensemble approach to commodity trend using different look backs and everything, stuff that you guys are very well aware of, as far as like, using a dimmer switch instead of an on-off switch, that you guys work with Corey a lot on too. So, we believe that you can build that overarching portfolio where long volatility tail risk is a piece of, and it's going back to that idea of, you just want my savings to outpace inflation over time. And we view that the difference though between Chris Cole's Dragon portfolio and what we look to build is we're entrepreneur first. And so we really believe in entrepreneurs. So we believe in small active managers. And we believe that gives us an edge, because when people look at alpha and beta, they're always looking at just the nominal return, right? These active managers have dragged behind the S&P by 2% annually. And I go, great, that's just nominal return. What was their MAR ratio? What was their return to drawdown? And that's where you see the active managers usually excel, is on the risk mitigation for drawdown, not necessarily volatility, but drawdown. So if the S&P is at, say, a 10% return with a 50% drawdown, and this manager has an 8% return with a 20% drawdown, I can combine that in a capital efficient portfolio. And using other uncorrelated pieces, it makes a much more robust return to drawdown. So that's the way we look at it, is each of those pieces to the Dragon portfolio, we look at using active entrepreneurial managers to reduce that risk, create an ensemble approach. That way, as you guys know all too well, we reduce the signal to noise ratio. We get a much more robust signal. We reduce the drawdowns, and then we combine that with the same ensemble approaches to the other pieces of the Dragon portfolio. And that's what we're working towards, that we think will be, that's what we can look at to protect our own selves and our families and clients as well.
I like the way you mentioned that as like the Dragon portfolio as sort of an evolution, really, of Harry Brown's permanent portfolio and risk parity. Really, it's all the same line of thinking, right? And really what the Dragon portfolio does is it takes a global risk parity portfolio and it adds an extra dimension, which is, maybe you want to call it convexity versus concavity, or divergent versus convergent risks. And so, you could take a global risk parity portfolio and you can add, I don't know why we keep calling it commodity trend, but like diversified trend following, and maybe
why we have to do that
or whatever, because Chris Cole called it commodity trend.
No, because how many CTAs went after large AUM and now they just trade the most liquid instruments and commodities are out of their portfolio. You have to find the smaller managers that actually still trade commodities. Imagine that, trading commodities without vol targeting.
Commodities, right? You're just trying to create a convex risk profile, right? Which you can do by trading any combination of instruments.
Do you think it's convexity or also the positive drift, right? Yeah. I mean, the long-term sort of exposure passively to equities as an asset class is muted. So you're hoping, I think you're hoping that you're going to have a tailwind as well as convexity if you add the trend. But
in two ways is what's interesting in two ways is, like, if you pair it with buy and hold equities and you pair commodity trend or CTA trend, you actually need the buy and hold equities. If you start trending equities, that actually throws off the correlations with those. So you're looking for that uncorrelated trade. The second part is, I'm more looking at, one, those commodities being uncorrelated and as we know, the kind of payout profile of them. But more importantly, it's more about like the inflation side of it, right? And that's what, like, basically Chris is carving out from permanent portfolio, that inflation side of gold, putting some of that in commodity trend. At least that's the way I see it. Is that, let's talk about like gold for a second. Is the gold path you need, is the way gold works for you is it outpaces inflation, right? If it keeps pace with inflation, it's okay. Or if it loses inflation, that's what you're really looking for. So the way we kind of look at commodity trend is that by diversifying across like grains, metals, energies, one of those or multiples of those are going to keep up with or outpace inflation. So that's more of the inflationary hedge. If you think about permanent portfolio, gold was to be that inflationary hedge. I'm not so certain it is anymore. Or gold is a single path dependency, whereas commodity trend has multiple path dependencies to try to hit that inflation hedge.
And
I also thought about it. Like, I think it's just really an evolution of that concept. It's just, thinking about it as long only versus long short trend is like you can say the exact same thing. So a global risk parity portfolio, let's say it owns a bunch of global equity indices, a bunch of global bond indices, and a variety of global commodity indices, including gold, but also including, as you say, grains and softs and metals and energy, et cetera, right? So that's a global risk parity portfolio, holds all of those different dimensions of risk, and you've got nice risk balance and what have you. If you overlay trend following on all of these different dimensions, then you've got long only plus long short trend following means that if you size it right, when the trend following sleeve is short equities, you keep in mind you've got this strategic long only equity sleeve. So when the trend following is short equities, you're just neutral equities, right? Or zero equities. When it's, you've got this long commodity sleeve. Well, when the trend following strategy is short commodities, then now you've got zero commodities, right? So it's really just like a timing overlay on this diversified basket of exposures, some of which are going to thrive during a deflationary episode. Some of them are going to thrive during periods of benign inflation and robust growth. Some of them are going to thrive during periods of poor growth and larger than expected inflation. And the trend following overlay is just sort of de-emphasizing those markets that maybe have a lower drift during this macroeconomic regime. And so it's just different ways of saying the same thing. Like you can have a diversified global risk parity portfolio combined with, I love that the dogs are barking, combined with a trend following and a tail protection strategy. They all amount kind of to the same thing.
Chris Schindler when he was talking about his commodity sleeve, he said, commodities don't have positive risk premium. So I just decided to do something different. He basically alluded to a commodity trend as the commodity side of risk parity and called it risk parity, right? But that's not like, the diehards risk parity guys are not going to do that. There's some positive risk premium in trend and commodity trend. So if you can get your cake and eat it too, your positive trend factor and that inflation protection and that non-correlation to your equities and your bonds.
But coming back to the way Jason framed sort of the long buy and hold equity portfolio. So you've got a nice risk premium there. And commodities, I think this is changing, but commodities historically have been an input cost for that long equity book. And that input cost has implications for profitability. And so if you are timing your commodity, you have a commodity trend exposure, you are offsetting some of those cost increases that are happening in your equity book when commodities are trending up and can be a headwind to the potential profitability of your equity book. Mm-hmm. You're also when they're short, obviously, in a traditional economy. Now the economy's changed a lot. Obviously, we're in a bits and bytes economy now. So there's, what has occurred over the last 100 years. These structural relationships may or may not proceed in the same fashion, but I could certainly see that from a very sort of first principle structural basis kind of resonated with me when you said, well, you got your equity book, you're buying, holding in that, but then you've got input costs. So what do I do about these input costs? Harry Brown said, gold is just another currency as a proxy to hedge inflation and those costs that might be going in, and just did one asset class. When you start to expand it, it gets a lot more complicated. But I don't know, what do you guys think of that?
Yeah, I was going to touch on one thing you said, Mike, but I got a couple of questions for you guys that I wanted to ask you. Is like, one is the way we try to look at, if you take this ensemble approach to commodity trend and to tail risk, long volatility pieces, is that if you can get those to a flat or slightly positive carry or as close to zero as possible, they're not that drag on the rest of the portfolio. And then you can use your notional exposure to have much more exposure to those implicit short volatility assets like the stock exposure. And so therefore you're actually out competing your neighbors without the drag on the portfolio. And those things are just laying dormant. If it's 10 years before you have a target rich environment for commodity trend, they're just laying dormant, just waiting for that to happen. Meanwhile, you have much more stock exposure than you would have in any other portfolio. And so that's why you have to argue all the pieces together than any of the individual pieces. So part of that is I wonder with you guys is like, when you're building these ensemble approaches, the literature would say that you need 7.5% conviction of any trade or any manager to have that diversifying effect. How do you guys think about, how much position size each trade would need to have any sort of a balancing effect or conviction, like to the ensemble approach to the portfolio?
To matter, you mean?
Yeah.
Well, I think it depends on the number of bets in the portfolio, right? I mean, I don't know how you get to a 7.5 seems arbitrary. So I don't know
that's some of like the academic literature on what a conviction minimum would be to have any effect on the portfolio.
Well, I mean, for example, if you've
like
only got equities in the portfolio, then I guess you would want to have, if you've only got equities, it's one bet. So you'd want to have at least 50% of the risk exposure in at least a completely different bet, right? And I think that's the challenge with traditional portfolios is they're almost exclusively equity risk, right? But to the extent that you can expand into multiple bets, I mean, if I look at the global risk parity portfolio, let's call it 65 or 70 futures markets, there's something on the order of 9, 10, 11, 12 bets in there. So you want
that varies
all of those bets to have approximately the same amount of risk exposure, right? So
but 9, 10, 11, 12 is 7.5%. That's why I think it's interesting, right? That whole bucket has
And I don't know very many investors that actually have 9, 10, 11, 12.
And the problem is when there's three, you shouldn't be doing 33, 33, 33.
Exactly.
I mean, that's not particularly wise either.
The other thing that Mike touched on that I really wanted to ask you guys about that always bothers me is we've talked actually throughout this conversation, they brought up VRP, volatility risk premium, and ERP, equity risk premium. I'm not sure either of those exist. So if you can go decades,
they don't exist.
Right. If you can go decades,
nothing exists, and we're gonna like this.
But I mean,
we don't know where this conversation goes. I think
very deep conversation.
You know where I stand. You guys chat.
If you can have negative for decades, if you can have negative ERP or negative VRP, then that doesn't mean there's a risk premium. It's just this thing we make up. But then part of that, what I'm really getting to is when you build this well-balanced portfolio and you rebalance frequently, you get a rebalancing premium. But I feel like when we talk about rebalancing premium, people think it's fucking magic. And like we made it up when you can show the mathematics of it, but you start talking, I don't know if you guys kind of soft pedal on rebalancing premium. I internally do.
It's absolutely at the moment. And I think it's a wonderful, magical premium that everybody should be thinking about because especially in this low return environment, we've got bonds at 0.5 to 1% return over the next 15 years and equities at arguably, somewhere in the sort of 2.5 to 5 range, then every extra point of rebalancing bonus or any other type of premium really makes a huge difference. And if you look at the sort of a typical stock bond gold portfolio, then the expected rebalancing premium, assuming you're using like a 20 or 30-year treasury, the typical annualized or historical annualized rebalancing premium is on the order of 1 to 1.25%. The amazing thing is if you allocate appropriately to maximize diversification in a portfolio with 9, 10, 11, 12 different bets, like a diversified global risk parity portfolio formulated the right way, that premium might be 2 or 3% a year.
Yeah.
So you go from 1.25% from even like a portfolio that's more diversified than most people own. So stocks, bonds, gold, 65 or 70 diversified asset classes constructed in the appropriate way to 2 to 3% per year in expected premium from your balancing bonus. I mean, absolutely. That was a really, really good point. I'm glad you brought that up, and it's a current focus.
The challenge, though. Go ahead, Ron.
I was just going to say that it's one of those objections that drives me nuts about this whole concept of being diversified. And why would I own any bonds? What the risk parity is going to be terrible because of this and that. They don't understand that by taking away any diversifier, by just being concentrated in equities, you're taking away a massive, real mathematical entity premium. Like we don't need to argue about whether this exists. If we believe these things to be non-correlated on average, and we can do it the right way, as Adam's writing an awesome paper about this, then you have this massive premium that nobody talks about, nobody knows about. And in fact, like you said, I don't know where you stand on this. Do you hate it? Most people do, right? Because most people think about this rebalancing premium within rebalancing your equity portfolio, right? You got 50 stocks, and every time you rebalance, what's that premium? It's between 0 and 50 basis points.
They think of it as
2 to 3%.
I don't think most people think about it. Most people think about the fact that over the last 12 years or 11 years that the S&P 500 has crushed everything, and that any rebalancing that you would have done, any diversification that you would have done, subtracted from what their buddy did next door. And so it's just not a sustainable, unless you are a thoughtful long-term investor that will invest over multiple cycles. It's just not a thing. I mean, at the end of the day, I believe gold is still outperforming the S&P over the last 20 years, and long bonds are outperforming the S&P over the last 30.
But risk parity, proper risk parity, levered to 20 vol global equities hasn't done too shabby either over the last 10 years. But you can't. Why you're not going to
leverage?
I don't want that type of volatility. But that's you're invested in 20 vol. This is what you've invested in. You can't do
really
that over here.
I'll take the other end. I'm not really. Look at my 10-year vol's not that high.
How do you guys think about though? How do you guys think about? I think about this often. Is like if you think about rebalancing premium, the idea of any sort of rebalancing is a form of short volatility or selling a straddle, because people say you're rebalancing is a mean reversion. It's implicit short volatility. I semi agree, but I also like to look at it more as like you're monetizing the trend of the other asset classes. So because you're not going, it's not a light switch, you're using a dimmer switch. So as you're rebalancing, you can be monetizing the trend. You're not truncating the left or right tails. You're still riding them. It's slightly mean reverting, but it's also, it has the U shape as well.
Well, and also it's not a pure martingale type short vol type trade, because clearly you want to harvest rebalancing premium from markets that are either orthogonal or, if you can get it, negatively correlated, right? I mean, if the two markets are negatively correlated, if one thing's dropping like a stone and the other one's rising, right? And I'm not suggesting that we can always count on, for example, stocks and bonds having negative correlation, but ideally you're going to want to put a variety of assets in the portfolio that are not all dropping at the same time. And in fact, if some are dropping, it's because of economic dynamics that are causing others to rise.
Yeah. Right? I think meats and S&P or NASDAQ probably relatively uncorrelated, and corn and freaking the XLK would be marginally uncorrelated. And if you develop these types of strategies or the access points to these differentiated return streams.
I just want to also make sure that we know that we're actively ignoring Corey Hofstein's question, because I don't know the answer.
Corey's question is
who
pays, and the answer is we'll tell you later. No, I'm just kidding.
Yeah, exactly.
But Adam, let me ask you this: like you were just saying, as you were singing the praises of a structurally negatively correlated trade, I might just raise my hand on that. Is if you could, I don't know if you saw, but they wheeled in a couch behind you. So if you could just lay down on the couch and tell me why you hate long volatility and tail risk so much, we can work through this.
Well, the point of a rebalancing premium too is that hopefully you could find things to rebalance into that have a long-term positive drift, right? So keep in mind, I don't hate tail hedging. What I do, I think it's very difficult for clients to stick with. I think it's very difficult for managers to include in portfolios because they have to answer to clients in the short term. And I think it's very difficult to do well because you've got issues about monetization timing, about, we were talking, we just glossed over this earlier about position sizing, right? Well, how are we position are we position sizing on nominal? Are we position sizing on delta? Are we position sizing on gamma? Like, are we changing our position sizing as Vega rises and falls? On what period are we rolling? Like, how much theta decay are we willing to tolerate in order to get the appropriate the gamma that we want? And we've had good conversations about this, Jason, where you're very humble about the fact that there's no good answers to this. And we just want to, like you say, have a good ensemble of things that are designed to protect against a mosaic of different types of risks. And I like that answer. It's like, you just want to be generally correct so that we can avoid the possibility of being specifically wrong or minimize the possibility of being specifically wrong. I like that answer. Yeah, but it doesn't.
Yeah, go. You went, like I said, you went full quant. You just can't, if it doesn't have a good Sharpe ratio and you can't fit it into an efficient frontier and you can't Vega hedge it, then it's just worthless.
Well, no, I think that's a fair statement, Jason. And I actually don't think that you need precise answers to say all of that and then come to a 100% conclusion that zero is the right allocation. I don't think that we would say that either. I think that's just an outline of the things one has to consider as you absolutely should have an allocation to something that does this type of thing in your portfolio. These are the complexities that you have to deal with in coming to some sort of position size, which is to say zero is not the right answer. I would suggest.
Have you
also try to pinpoint a correct answer is also suspect.
There are no correct answers. There's no equity risk premium. There is nothing. This isn't even happening right now.
Also, the specificity of I think Jason's totally right. Like the permanent portfolio, risk parity, dragon portfolio. At the end of the day, they all kind of end up doing similar things, right? And so it's almost like you just choose one and stick to it. Whatever, like you don't. When you get too specific, one of the things that bothered me about some of the papers in like the dragon portfolio is that it's not like 1/5 each. It's like 19.5 here and 22.5 there. We're trying to be too specific. There's these broad metrics and this broad beliefs as to how you should structure it. Do that, and you should be generally fine, right?
I just want to apologize too to the millennials on the line who I obviously take exception to my acrimony in.
I love
Yeah, I think,
millennials.
Corey,
So-
Corey can't understand. This is how Gen X people show their love to each other.
That's love, man.
So Jason, I would love to actually also know on a more serious note, or I'm going to say equally a serious note. So when you're looking at all of these emerging managers that you're putting together and assembling and ensembling, what's the process you go through? I think actually a thoughtful process on how you sort of interview, select, put together managers, that's as hard a task as there is. Never mind the risk premia. I think that's got a level of dimensions beyond just the risk premium that you might try to harness that is very complex. So I would love you to, just give us what you learned, what you've learned thus far, what you learned in the interviews, how you might replace people as you continue on your mutiny journey, because there's a lot there that we haven't even. I hope you have time. I mean, we're at an hour 20 now, so. If you've got time, I think that this is I'm really interested in this particular area too.
3 hours on us.
Yeah. So I go back to I think about during this conversation I've actually been thinking about MEB a lot in one of my other back of my mind is like MEB reminds me I used to live in the South and these guys who do all this shucks I'm just a Southern guy, I don't know what I'm talking about and everything. To me, like that's MEB's shtick, but MEB's a genius if you think about some of the things he talks about. Like Rodrigo's just hitting on one of them. MEB did a study on like the portfolio construction, didn't even need to be exact. If it was roughly right, that was good enough. But one of the other things MEB talks about is like he falls in love with every investment he looks at. We all have the cognitive fallacy. Like we fall in love because everybody's showing us great back test. They're so smart, right? They all went to Ivy League schools, especially the managers we deal with. They all went to Ivy League schools, then Goldman Sachs, then prop firms, and then their own hedge funds. And they're all geniuses. It's all amazing, right? So it's hard not to get sucked into the narrative. But the way we structure it is I think slightly different. And to me is as long as anybody just wants access to these managers and that's what they use us for, and they think I'm a portfolio construction idiot, great, just use us for access. But the way we thoughtfully try to put this together is we look at specifically, we try to buy as many options as possible. So the entire portfolio is constructed around buying options because we all know what that debit card bleed is of those premiums. So you can't blow up when you're just buying options. But the way we look at buying options is we look about across the moneyness. So we might use like a Logica for the at the money straddles, and they're covering maybe that -5 and -15% move primarily after you pay up for the premium on the other side. Then you look at like an Artemis option profile that's much more strangles. We have like Headwaters volatility that's much more maybe opportunistic and is looking for cheap convexity, but it crosses that line of moneyness maybe from 10 to 40% out of the money moves. And so those guys are very dynamic in the way they're trading options. They may be, market timing a little bit or just adjusting their inventories of options. So, we added back in those deterministic rolling puts just in case something were to happen on a Saturday or Sunday, some sort of exogenous event, and our managers weren't fully in the market. We want to be able to sleep at night. So we added those back in because we think we can carry that cost via the overall portfolio construction. Around the periphery, we added in this VIX arbitrage, which is like a relative value, VIX trading, which still has a long vega or long gamma profile, which is fantastic. And then we talked about the short-term intraday trend on the stock indices going short those indices. When we look at those managers, what we're really looking for is a wrinkle of diversification. So once again, it's like, I'm actually saying something ridiculous. I want a beta signal from volatility arbitrage and those short-term trend managers. And I can create a beta signal out of them if I create an ensemble approach to that. And all of them have different heuristics and timing of the trade, but more importantly, different heuristics for monetization. And so if they offer a different wrinkle and I can combine, a handful of them into that basket, I can create a more beta signal out of VIX arbitrage and a beta signal out of the short-term trend. And what that does is it provides a much more robust return stream that helps me pay for that potential bleed of the options. So that's the way we look at it. And part of that, diversification is what's been fascinating is during a risk on cycle, our managers are fairly uncorrelated. And then in risk off, their correlations go to 1, which is -1 to the S&P. So we have this very serendipitous converging correlations. So we really like. So it's more about finding somebody with a slight different wrinkle to volatility arbitrage or short-term down capture to see how that combines at the ensemble level. And then the options are really about trying to cover as much of that moneyness and then those different monetization heuristics to make sure you capture that move and make money off that move and capture the meat of that move.
So
I like that because there's a lot of because of the nature of the distribution of the underlying strategies, just by their nature, there's a huge amount of dispersion in the different outcomes from the different funds. And so this is where an ensemble approach can really show its strength by trying to narrow that distribution, just your averaging error terms, and you're just narrowing right in on the signal, which I think is a really good concept.
And if you think about, sorry, I get that, but if you think about the dispersion, not only you have wide dispersions, but then you have 3 different market microstructures with VIX options and short indices futures. And so that adds, to the interesting part of those bucket dispersions. And then Richard, I think you were asking, we rebalance quarterly. Unless a single manager is up double digits in a month, then we'll rebalance across the portfolio. It's an issue of granularity. As AUM grows, we might move that to monthly no matter what, but it's a granularity issue when you're dealing with the contract sizes that we're dealing with.
Yeah, it's
remember Adam. Sorry, Rick, go ahead.
We were discussing earlier about the benefit of having that rebalance and just something that just has shot up 3 standard deviations, just cash that excess, put it back into the rest of the portfolio. So yeah, it makes a lot of sense.
One of the things I think in the first podcast when we discussed tail, Adam, was one of your concerns was what happens if you get it specifically wrong. Like you pick that guy that was supposed to pay off and we're like 50 basis points away from the payoff and we never got it. I think one of the things about the way that these guys have approached it is that there might be 1 or 2 of those guys that never get hit, right? But because of the way the asymmetry works in these strategies, when one of them hits, it's massive, right? It's not like you are giving 1/10 of the portfolio across 10 managers and they only get 1/10 of the impact. On the asymmetry side of things, you can make it so that their impact is 100%, right? Yep. So I don't know if you structured it that way, but there's ways of mitigating against that diversification risk of ensembles if you don't hit all the triggers.
It speaks to size, right? So maybe Jason can also talk about the sizing because you've talked about the different strategies and the different styles, and that helps us just get a good grasp of what you're trying to hedge across this spectrum of risks and moneyness that you were talking about. But I guess the sizing also makes a big difference here.
While you're talking about sizing, maybe touch on netting too.
That's what I was going to get to Rod's. Yeah. Perfect. So I think Rod was actually going down that road perfectly. So most people worry about netting risk. There's 2 ways to look at netting, but like if you have an ensemble approach and everything, they're worried about, what about that payout? What if some managers catch it, some don't, and you lessen the convexity via an ensemble. Well, the beautiful thing is when you're building an ensemble with VIX arbitrage and short-term futures, and then the options bucket is you're maintaining all that convexity of the options. So the ensemble approach is beautifully just reducing the noise during the risk on cycle. When the risk off cycle happens, we're sitting on a massive inventory of options. So going back to Richard's, it's like we think about that moneyness primarily. So we'll maybe overweight closer to the money because we need more of that kicker there, but they might require more premium. And then so it's more about the probabilities. So it's like weighting based on the probabilities and the moneyness, and that combination leads to a better construction of the options bucket.
Very cool.
Wow. Oh, I think you're muted, Adam. I think you might be muted. Sorry,
I was just so passionate. I was
it was that damn dog. Whoever's dog that is. Shut up.
I was just going to say it's been 90 minutes and we finished on a high note. I think we were in violent agreement there at the end, which
surprising.
The last 5 episodes have not been that. Yeah. Everybody's happy. I think people can take away something positive. The world's not exploding.
We still hadn't talked about how we actually, I get the portfolio assembly and all that sort of stuff, but the interviewing of these people, how did you decide on these people? So, but we can leave that as a teaser for an interview down the road as well. Because I think that is that. But
6 a.m. tomorrow. for everyone?
Yeah.
Or that can be the stinger after the credits, right? We'll let the credits roll and we'll show that one at the end.
That's right. We'll meet you back here tomorrow. Same cocktail, 6 a.m.
Awesome.
We
Jason,
got time on that, I think.
If you have time and energy for it, Jason, I'd love to hear that. And then how
Yeah.
you're monitoring on an ongoing basis, how, like,
Yeah.
you never want to replace one of the managers you have. How would you think about that? Is the ongoing monitoring's in place, all that sort of stuff? If you got...
Before you answer, I have to go do some pickups and drop-offs and stuff for the family. So I will let you guys be. Enjoy the conversation, Jason. We'll see you guys next week.
See you, Roddy.
Thanks, Rod.
See you, bud.
Yeah, so just like you guys, like this is my favorite subject in the world. So happy to continue the conversation. So when we are interviewing managers, we look at one, we actually, like if we said everybody has a great back test. So we just like to talk about where they get hurt. And then we talk about layering in, the different ensemble approach to where they get hurt. So that doesn't make us the most, high returning portfolio, but it helps robustify the portfolio if robustify is a word. So that's the way we look at it. And then, like I was saying, we focus on the moneyness of those options. So you guys kind of know this is like, it's a very niche market. There's probably only 30 to 40 players, and we've been tracking all of them, and I've been tracking most of them for over 5 years. And then it's also, every year going to contacts in Miami, meeting them with there, always talking to them on the phone, flying in to see them. But that's how we kind of build the portfolio, is we kind of knew the structure of the buckets we wanted to create and what those buckets needed to look like. And then we're just trying to find slightly diversified managers to fill those roles and think about where they get hurt the most. Is, do we have somebody that kind of makes up for that? Because like I said, we want to, create that, just a slight, robust return during risk on, and then all that convexity for risk off. But then, Mike, as you know, the hardest question in the world, and you guys, I think, deal a lot maybe now with your Evolution Fund, is that how do you fire a manager? Why do you fire a manager? When do you fire a manager? Now, if you guys have an answer for that, I'm going to sit back and shut the fuck up. But like, it's the hardest question there is, right? Because as long as like everybody goes, oh, if they get away from their knitting, I'll fire them. That's easy. Yeah. If somebody goes rogue and starts selling volatility, I'm going to fire them. Like, that's the easiest question in the world. But certain programs will do well in certain environments, less in others, and our future drawdown's always ahead of us. So if they have their biggest drawdown today, but it seems like they're sticking to their knitting, have they lost their way, or is their style gone out of favor for a few months, a few years? Like, it's impossible to know that. And it's one of the things in our industry that nobody really will claim or raise their hand about, is that none of us really have a good answer for this. It's really gut feel, right?
It's an the frequencies that we observe the market at, for sure. Yeah.
I think there's probably probabilistic dislocations that might be obvious. If there's a, here's the structure, here's the cone of probabilities for the particular manager, and you see this operating outside of that, but maybe it's the,
I think, because the distribution is so strange, right?
Correct.
Yeah.
And it could be like you point to, it might be the actual strategy that filled the area of that the moneyness that you were looking for is just that much out of favor. The manager is actually doing what you want. The outcome is not what you thought. So I asked this question just because it is a really tough question, and I was hoping you had the answer.
No, part of it is like, think about that moneyness, like Rod brought it before, is like, if you had a manager that you were covering that negative 20% like attachment point, and the market drops 18%, well, you never hit the strikes, so you didn't make any money. So you kind of got egg on your face, even though you just told your clients that. But the way Taylor and I think about it is like, we have Thanksgiving risk because our friends are, and our families are in this. So that's why we're trying to overlay those moneyness and overlap it. So like you pointed out, if a manager misses it somehow, or it didn't touch the strikes they needed, or it didn't have the path dependency, to Adam's point, it didn't have the sharpness of the move. All of this stuff is so difficult to hit that path dependency just right. That's why we think it really lends itself to this ensemble approach of layering them on top of each other and overlapping those Venn diagrams to try to make sure you capture that meat of the move. Because especially if it happens once a decade, you don't want to be like, we're your guys for the sell-off, and then the sell-off happens once a decade, and we're like, well, this it wasn't quite the move we thought, so we're doing the best we can to try to make sure we don't have to have excuses, once every 10 years and go out of business.
Yeah. I could just see the board meeting.
The convexity of the exposure will be, but you do know that you'll be there for some of it anyways. You'll do some of the job that you were paid to do. Exactly.
Yeah. And I hate those shock tests people put. Like there's a lot of managers we talk to. They're like, here's a shock test of if it looked like 2008 or 2011 or 2015, all the different like micro crises. And this is the shock of our portfolio now. And what it return like? It's just never going to look like that.
No, exactly.
I love it. And I'd love to hear the board meeting. There was a board meeting at CalPERS where they decided to pull it all. Yeah. And then there's some guy at that board meeting, we got to get rid of this thing. And he's sitting there like looking for new boards. Then you got Wimbledon. I mean, Wimbledon has been buying insurance for a pandemic for 19 years. And you can you imagine if there was a board meeting there last year and they're like, we don't need this thing. And they're like, just keep it one more year.
How did you guys handle it internally or outwards to clients when, you probably experienced, a different kind of drawdown in February, March than your models were expected, or to be at kind of the extreme of your models? And how did you manage clients through that?
It looks like it's time to go. See that
well, it's a really good question because it's like for trend followers, right? Like you've got the trend followers so often position as being crisis alpha, but they're only crisis alpha if the skew manifests at a very specific frequency, right? If the skew manifests at a monthly or preferably quarterly frequency, then that's when most trend followers are really going to do well. You've got some ultra short-term guys that maybe profited with a few weeks, but you've got to be just so unbelievably short-term to be able to take advantage of a move that happens that quickly, which admittedly had literally never happened before. I mean, it was 3 times as fast as the move in 1987, right? So you can't build a model that is tuned to that. You've got to just sort of be positioned, like you say, for a crisis that happens in a way that no one's ever seen before. And I think so that's where your type of strategy really comes in handy. And then it's just a question of how much you're going to pay for it, how much do you allocate to it. And I think that was a really good lesson in risk management this March.
Yeah. I mean, the other thing was that we had a pretty significant run up. So there was a significant amount of paper gains that were given up prior to. So, but again, as much as we say paper gains, everybody thought they owned those 100% and they were in their portfolio. So it's like, I fully recognize that, that's not an excuse. It doesn't matter. And, there's improvements that have been made and will continue to be made. And that's the evolution. And I think that's what I'm hearing from you as well, is that there's managers that you have in place and you are constantly looking for new managers that will add those wrinkles in order to continually develop a really robust process that has at least a break even or a slightly positive carry that allows you to do some other things too, that really kind of round out the tail hedge, which is incredible. Well, I was keen to get those last 2 little bits in about the managers and manager selection. And other than that,
I'm going to copyright that endorsement by you. I think I'm good now. I'm going to cut that and paste it on our pitch deck.
TM. Yep. Done. Well, thank you for taking all the time. I don't know about you guys. You have anything else left?
No, I think that's it. That was great, Jason. Thank you.
I know. I gotta. If we're gonna continue, I gotta take a break because I gotta go get more.
I'm out. I gotta go too. Yeah.
Good luck. Are you interviewing your what's his name? Diego Parilla? Is it?
I actually did that right before we got on. Diego and I did 2 hours, and then I had like a 30-minute break, and then we got on. So, yeah, it'll come out in a few weeks.
Oh wow!
Yeah,
raspy voice or anything, man. That's great.
Yeah.
All right, cool. Thanks so much for coming on and giving us.
I just got a DM from Rodrigo. He said our risk parity crushed it, by the way, in that period. So I was thinking of different mandates, but I think he's everywhere all the time. You can't say anything without him being here.
Yeah. Have a great weekend, everyone.
See you guys.
Thank you so much, Jason. Yeah, don't text while driving.
See ya.
Totally.
Bye, guys.